Swinging to fourth quarter profit, French bank Société Générale vows to return more cash to shareholders in 2014. It comes after France's second largest bank capped a long-running push to boost the strength of its balance sheet. It sold assets, cut jobs and pulled out of markets like Greece and Egypt. And it was good news too for Dutch bank ING, also reporting better than expected results. It's in the final stages of restructuring and will review early repayment of its final tranche of state aid after selling its insurance business and completing crucial European banking tests. This could pave the way to resume dividend payments. They were halted after its bailout in 2008. The news saw shares in the group surge over 3% in early trade. IG's Alistair McCaig says the bank's strategies have paid off.
When we look at some of these European banks and compare them to UK banks, there is a sizable difference, I guess, in their exposure to mortgages, and I guess the fines that have been incurred therein, the mis-selling of PPIs and the likes, are heavily linked to the mortgage scene. So SocGen and ING have managed to a certain extent avoid those pitfalls.
But concerns remain about European banks' exposure to emerging markets, where they've loaned in excess of $3 trillion, more than 4 times US lenders. This puts them at far greater risk if financial market turmoil in countries such as Turkey, Brazil, India and South Africa intensifies.
I think all European banks, whichever side of the channel they might be, are going to face arguably some bad debts coming their way from emerging markets due to the fact that we really are a couple of steps down that road of the US tapering back its quantitative easing process, and that looks very much like it'll continue at a fairly healthy pace.
But SocGen's CEO, Frédéric Oudéa, is optimistic about growth this year.
At the end of the day, we remain overall relatively positive for 2014, with a growth in the world marginally better than last year, in particular in the Eurozone. Again, there can be volatility. Some emerging markets will grow probably a bit less, and maybe sometimes it's good to avoid too much bubble in the debt sometimes.
But many feel emerging market exposure could be a headache for the industry, just as it faces a rigorous health check by the European Central Bank. The so-called stress tests aim to expose weak points and restore investor confidence in the wake of the 2008 financial crisis, with results published in October.